Most people think hitting $100,000 in savings is the finish line. It's not. It's actually where the real game begins. And if you don't know what to do next, that $100,000 will sit there, losing value while the cost of everything around you keeps climbing. Today, I'm going to walk you through exactly what to do once you've saved $100,000 in Australia, so your money actually starts working as hard as you did to earn it. Let's get something straight first. If you've saved $100,000, you've already done what most Australians never do. Recent research shows the average Aussie has about $42,000 in savings. So you're more than double that. You're ahead. But here's the trap. A lot of people hit this number and then freeze. They don't know whether to invest it, pay off debt, buy property, or just leave it in a savings account. And that indecision costs you real money every single day. So the worst thing you can do right now is nothing. And the second worst thing is making an emotional, uninformed decision just because you feel pressure to do something. What you need is a clear plan, and that's exactly what we're building today. So step one is boring but critical. You need a proper emergency fund locked in before you do anything else. The government's own MoneySmart website recommends 3 months of essential expenses. But if you can, push it to 6 months, especially with the RBA cash rate now sitting at 4.10% and cost of living still elevated. A 6-month emergency buffer for most Australians sits somewhere between $15,000 and $30,000 depending on your lifestyle. Park that in a high-interest savings account. Right now, you can get ongoing rates between 5% and 5.50% from providers like ING, UBank, or Rabobank if you meet the monthly conditions, with some introductory rates going even higher. This isn't your investment money. This is your sleep-at-night money. It's the buffer that stops you from panic selling your investments or racking up credit card debt the moment something unexpected hits. A car breakdown, a medical bill, a job loss. Life doesn't send warnings before it sends bills. Now, once your emergency fund is locked away, here's where it gets interesting. If you're carrying high-interest debt, credit cards, personal loans, buy now, pay later balances, you need to attack that next. It doesn't matter how tempting it is to invest. No ETF on the ASX is consistently returning 18% to 22% per year, which is what most credit cards are charging in interest. Paying off a $10,000 credit card balance at 20% interest is the equivalent of earning a guaranteed tax-free 20% return. And here's what most people don't think about. Once that debt is gone, the monthly repayments that were going to the bank are now free cash flow. That money can be redirected straight into investments. And psychologically, something shifts when you become completely debt-free. The mental weight disappears. Suddenly, every dollar earned is yours to keep, yours to grow, and yours to direct wherever it creates the most value. But what about HECS-HELP debt? This is where a lot of people get confused. For the 2025 to 26 financial year, the system has completely changed. The minimum repayment threshold has jumped to $67,000, and repayments now use a marginal rate structure. That means you only pay 15 cents for each dollar earned above $67,000. Not a flat percentage on your entire income like the old system. It's actually much fairer now. But here's the key point. HECS is still indexed to CPI, so it's not compounding at 4% or 5% like a mortgage. In most cases, you're still better off investing that money elsewhere rather than voluntarily paying down HECS faster. All right, let's talk about the big one, investing, and specifically index fund ETFs on the ASX. If you're new to this, an ETF is an exchange-traded fund. It lets you buy a tiny slice of hundreds or even thousands of companies in one single purchase. For Australians, the most popular options right now include VAS, which tracks the ASX 300, IVV, which tracks the US S&P 500, and VGS, which gives you exposure to global developed markets. The beauty of ETFs is simplicity. You don't need to pick individual stocks. You don't need to follow the market every day. You just own a broad slice of the economy and let compounding do its thing over years and decades. Now, should you dump all $100,000 into ETFs at once? Not necessarily. A strategy called dollar cost averaging lets you invest a fixed amount at regular intervals, say $5,000 or $10,000 per month, instead of going all in at once. This smooths out the bumps. You buy more units when prices are low, fewer when they're high, and over time, your average cost per unit evens out. It takes the emotion and the guessing out of the equation. Vanguard Australia themselves have published research showing this approach helps investors stay disciplined and avoid panic selling during downturns. And discipline is the single biggest predictor of long-term investment success. Now, here's a move that most people under 40 completely overlook: superannuation. I know it's not exciting. You can't touch it until you're at least 60, but the tax advantages are enormous. Right now, the concessional contribution cap is $30,000 per year. From 1st July 2026, that's going up to $32,500. If you salary sacrifice into super, those contributions are taxed at just 15% instead of your marginal tax rate, which for most working Australians is 32.5% or even 37%. That's an instant return just from the tax saving alone. And if you haven't maxed out your cap in previous years, you might be eligible for catch-up contributions, meaning you could pour even more in. If your total super balance was under $500,000 at the end of the previous financial year, you can carry forward any unused concessional cap amounts from up to 5 prior years. For some people, that means contributing well over $30,000 in a single year and getting a massive tax deduction for it. It's completely legal, it's built into the system, and almost nobody uses it. What about property? With $100,000, you technically have a 20% deposit on a $500,000 property, which avoids lenders' mortgage insurance. But in most capital cities, $500,000 doesn't go very far. Here's the good news though. Since January 2026, the First Home Guarantee Scheme has been expanded. There are no longer income caps, no annual place limits, and you can get in with just a 5% deposit with zero LMI. That means $100,000 could be a deposit on a property worth significantly more. But, and this is a big but, property also comes with stamp duty, legal fees, maintenance, council rates, insurance, and the risk of being locked into a mortgage, while rates are at 4.10% and potentially heading higher. So let's put this all together into a clear game plan. If you've got $100,000 sitting in an account right now, here's how to deploy it. First, carve out $20,000 as an emergency fund in a high-interest savings account earning 5% or more. Then wipe out every dollar of high-interest debt. Then salary sacrifice an extra few thousand into super before the end of this financial year to take advantage of the current $30,000 cap. And with the rest, start dollar cost averaging into a simple 2-fund ETF portfolio. Set it up, automate it, and leave it alone for 10 to 20 years. The reason most Australians never build real wealth isn't because they don't earn enough. It's because they never make their money do the heavy lifting. $100,000 sitting in a transaction account earning 0.01% is losing purchasing power every single day. But $100,000 deployed properly across an emergency fund, tax-advantaged super, and diversified ETFs can genuinely become the foundation that changes your financial future. The difference between someone who retires comfortably and someone who's still stressed about money at 65 usually isn't income. It's what they did at moments exactly like this one, when they had a lump sum, a choice, and the chance to set things up properly. If you got something out of this, subscribe to the channel and turn on notifications so you don't miss what's coming next. Thanks for watching, and I'll see you in the next one.